Hi, my dear buddies, how are you doing? So let's start off with a couple of interesting topics today. First, let me find my pen as usual. Got it. So, guys, lecture number 89, and we will start off with what do you say? Business of you know, business reorganization of cooperative banks, and we will do set off and carry forward and all those things. So we were doing, what do you say, amalgamation, demerger. So on similar lines, we'll finish off these two. It's very simple provisions. Business reorganization of cooperative banks. So guys, this is copy, paste, amalgamation and demerger. No change, honestly speaking. There is no change here. Except maybe there are around 2 to 3 differences. So let's just figure that out. Yeah, 3 differences are there, barring that, no change. So let me just business reorganize. This is page number 16.1, by the way. Business reorganization of cooperative banks. Same as amalgamation and demerger, except 3 differences. Difference number 1, remember that 75% or more of the shareholding 70% or more should come here. That is also there apart from an additional condition, because in this business reorganization of cooperative banks, guys, generally the impact will happen when cooperative society banks come together. It is predominantly set up as a mutual benefit society where they come together and then create these cooperative banks. So there are many members also who should take the benefit of this reorganization. Hence, one additional point is added that 75% of the members holding 75% or more voting rights. In the other provisions, amalgamation, what is the additional condition? That the shareholders holding 75% of the amalgamated, of the or more in value of the shares should also hold, what do you say, become shareholder of the amalgamated company. Shareholders here, members are also there. Members are different. So members of cooperative society also should come into the picture here. Members holding 75% or more of the voting rights in the amalgamating company, amalgamating bank, should become members of amalgamated cooperative society. Amalgamated cooperative society. That is difference number 1. Difference number 2, that carrying forward the losses, if you remember, in normal amalgamation, it is fresh period of 8 years. If you remember, if you follow provisions of 72A, fresh period of 8 years, but here it is only the balance period. Amalgamated cooperative bank can carry forward the loss of amalgamating cooperative bank for balance number of years, not fresh. For only the balance number of years. Third most important thing is section 44 DB. So in normal section, remember only section 32 is split, no? Between number of days between the amalgamating and amalgamated company. In this, apart from section 32, 35D, 35DD and 35DDA. These three things are also shared in the ratio of days. This is pre-operative expenses, amalgamation expenses, VRS compensation. This all will be shared between the three. So basically, number of days, it will be shared. So if they say that it incurred an expenditure of 10 lakhs on VRS, that 10 lakhs will be split between the two companies in the ratio of number of days based on when the amalgamation happened. Apart from that, these three are not available generally for companies, but an additional point for what? Cooperative banks. These three are the important things, guys. Barring that, everything else is copy paste, no change. See, transfer of capital asset by a predecessor cooperative bank to successor cooperative bank or the converted in a scheme of business reorganization is exempt. Same. Transfer in lieu of shares of successor company is also exempt. Yes, 72AB. Accumulated loss, this is the difference here, is only for the unexpired period. And as you know, speculation loss can never be set off against any of the successors cooperative banks income. Conditions, 3 years, fixed years, 2 years, all the same, no change. Demerger, it's the same, no change. 44DB, see these three things shall be apportioned between the two. So you see, Shikhar Cooperative Bank, just mark this example as important. Shikhar Cooperative Bank is amalgamated with Tony Cooperative Bank on 38/2022. Shikhar Cooperative Bank incurred an expenditure of 10 lakhs on voluntary retirement scheme and 10 lakhs was paid on 34/21. Reduction under 34 DDA to amalgamating cooperative bank, assessment at 22/23 is 2 lakhs. 35 DDA as per section 44 DB in 23/24, because this 10 lakhs is generally given to what, guys? 2 lakhs per annum. First year they'll get full deduction. Second year onwards, 1/5, right? 1/5 is allowed if you remember 35 DDA. So in this 2 lakh into which date it is? 38/2022. So April, May, June, July, August, 5 months. April, May, June, July, August. So 151 days. August. So 151 days there. 29 days. 1 day before I have to take, right? Then the other one 214 days. Once that is over, the other companies you will get 2 lakhs. We make this 2 lakhs size, not 22 lakhs. 2 lakhs every year. 2 lakhs every year. So page 16.2, this one here, last part, it should be 2 lakhs every year, not 22 lakhs. Just make that change, please. So 2 lakhs. And if you see, it may be noted that in the case of amalgamation of companies, in the above case, deduction is available to amalgamated company, it is not apportioned. We have seen this. So amalgamated company, the full thing is available, it is not apportioned, but here it has to be apportioned in that year. That's it, guys. In this, that is the only 3 things that you have to remember. All the 3 things we have done. Do not waste more time than this. It is not important. But those 3 differences they can ask in the exam in the form of MCQs, etc. That's why you should keep that in mind. Otherwise, really not needed. Simply don't keep wasting time on all those things. Now, let's do another chapter, set off and carry forward. G1, G2, G3 onwards. In that, if you remember, guys, G1 and all we have already done. So, we just have to do the other areas. So, we shall finish off this small chapter, important chapter, but we'll finish it off so that it becomes very easy for you going forward. Set off and carry forward of losses. So if you see, there are 2 things. One is set off, comma, then set off and carry forward of losses. So set off is just setting off that particular year. So income of a particular year set off against the loss of the particular year. It could be within the same head or it could be between 2 heads. One is set off, one more is set off, one more is what? Set off. There is carry forward and set off of losses. One is merely setting off. Merely setting off means setting off the losses of 1 year with the profits of the other. One is set off. One more is what? Carry forward and set off. Carry forward means what? Whatever loss is there, carry forward to the next year and then set off that. So that is what it is. So if you remember in this deemed income concept, we have done full charts and we already completed this 68, 69, 70, all that 68, 69, 69, C, 69, all that we have done. If you remember, this part is done. This we will have to do. And if you remember in amalgamation and demerger, we have done, what do you say? This part. This part is already done. 72A. Full we did. Till here, even this we finished. So barring this, other things we can finish it off. Very simple. In that almost 3-4 pages we have done. Remaining 6 pages are there. We'll finish it off, guys. Easy chapter. Set off of losses. So intra-head adjustment is section 76, whereas inter-head adjustment between one head and the other head is 71. That's all. Intra-head is within the same head. When the loss from one source of income is set off against the profit from another source of income, if within the same head of income, it is known as intra-source adjustment. That is long-term capital gain from shares versus long-term capital loss in terms of selling a house. Intra-head. Inter-head is what? Loss from house property. If you see loss from one house property set off against profit from another house property, intra-head. Inter-head means what? Loss from house property set off against salary income. So let's see this. Intra-head, that is within the same head, section 70. Intra-head is actually allowed, freely allowed. Except these things. Under these things, it is not allowed. That's all you need to remember. Speculation business loss cannot be set off. Speculation business is ultimately a business, PGBP income. PGBP. Generally, PGBP income loss should be allowed to be set off against PGBP income. But if it is a speculation business loss, this is actually treated as a distinct and separate loss. Though it is very much part of PGBP, it is considered to be distinct and separate, right? So speculation business loss can be set off only against any other speculation business income. Loss of a specified business, this we are done under 35 AD, will be only set off against other specified business income under 35 AD. This we are done already. Long-term capital loss can only be set off against long-term capital gains. Which means it cannot be set off against short-term. Because intra-ed means what? You may say that, sir, one is short-term capital gain, one is long-term capital gain, long-term capital loss. Can long-term capital loss be set off against short-term capital gains? No. Not against short-term capital gain. Loss from the activity of owning and maintaining race horses cannot be set off against anything. That is also considered to be a distinct and separate activity. Income from activity of owning and maintaining race horses only you can set off. Loss from any lottery, card game, races, etc. is not eligible for set off or carry forward at all. Losses from lottery, etc. you cannot, set it off. Any loss from a source which is exempt from tax, say agricultural income, it is not eligible to be set off or carry forward. So loss from agricultural income cannot go there. These are all the basic cases, guys. Very, very simple. So for instance, if I have a long-term capital gain through shares under 112A where I have paid 10%, and I have long-term capital loss again from shares 10%, I would have paid 5 lakhs is the loss, 6 lakh is the gain here. And here long-term capital gain jewelry 112 where I have paid 20%, the loss is 6 lakh. Now where should I do this loss? Where should I set off? It makes sense to set off against this because here the tax rate is more. So I can set this off, no problem. Correct? Nowhere it says it should be long-term capital gain in shares. It just says long-term capital gain should be set off against long-term capital loss. It cannot be set off against short-term capital gain. So this is very much possible. Then if there is a short-term capital loss under AAA where I have paid 15%, let's say 6 lakh is the loss, and there is a short-term capital gain where I have to pay 30%, 4 lakhs, and there's a long-term capital gain from jewelry where I pay 20%, 3 lakhs is the gain. One more long-term capital gain from shares, 112A, 10%, 4 lakh. So guys, first obviously this loss 6 lakh set off against this 4 lakh. Remaining 2 lakh is there. That 2 lakh whether to do this or this. Obviously it is better to set off this because here I will be paying 20% on 1 lakh and not 20% on 3 lakh. So it's pure common sense, set off and carry forward. Nothing, honestly, nothing great about it. Nothing extra to think of. Right? So this is the first part of the story. Very, very simple. So long-term capital gain, short-term capital gain, all that we have to understand. One example, important. House A let out $10 lakh is the income. House B is also let out. There is a 7 lakh loss. They did not pay salary and all that. Sorry, they did not pay the rental and all that things seen happened. 7 lakh. Can I set this off and only 3 lakh can it be? Finance Act 2017 says loss from house property can be set off against other heads of income only to the extent of 2 lakhs. So this 7 lakh, only 2 lakhs I can set it off against others. But guys, but section 70, which is what we are talking, has not been amended. Which means what? Full 7 lakh can be set off since it is intra-head. House property to house property, any amount. House property loss against other income, 2 lakhs. That's the golden rule. Write down somewhere. House property gain to house property loss, or house property loss against house property gain, any amount. House property loss against other income, 2 lakhs. That is an amendment there. And in house property, these are some extra points from there, it will come. Okay. Salary and house property notes have already been uploaded. So you have nothing to worry. It's already been uploaded. You can go through. These are some additional points in class only I have told. In clubbing, we did the deemed owner concept. So wherever it is coming, I'm already doing it. There's nothing much for you to understand, right? Yeah. Similar to clubbing of income, here an SSC is eligible to seek set off of losses also. Mr. A gives a sum of 25 lakhs to his spouse, which she deploys for commencing a business. Mrs. A suffered a loss of 5 lakhs. The loss shall be subject to clubbing, and accordingly, Mr. A could set off 5 lakhs against any other eligible income, because I'm clubbing the income, right? So even for clubbing, definitely there will be what? I can do the adjustment. So that was also held in JH Goat Law, Supreme Court judgment. Even the brought forward losses can be set off against minor child or anything, any clubbed income. Any clubbed income. So yes, that also you can check, no problem. On the other hand, anything from speculation business, speculation losses cannot be set off against any other income except speculation income. In case of Ranjana, loss from speculation business shall not be eligible for set off against software business, and thus total income would be just 10 lakh rupees. In the case of Sanjana, however, loss from software business can be set off against income from speculation business. There is no restriction for set off of loss from software business against income from speculation business. Accordingly, after set off, total income would be 4 lakh rupees. Inter-head adjustment between one head to the other head. Inter-head. This is section 71. Section 70 is intra-head. Section 71 is inter-head. As I told you, check this. Loss under the head income from house property shall be eligible for only set off against any other head of income, but restricted to a sum of 2,71,3A. 71(1) was not amended. 70 was not amended. 70 was not amended. 71(3A) was amended. Inter-head was amended, not intra-head. That's what I was trying to tell. So, house property loss against house property income, any amount. House property loss against other heads of income, 2 lakhs. Inter-head was amended, not intra-head. I am trying to make it as easy as possible for you so that you don't have to suffer, right? That's my intention. It will become easy and we can finish it off fast. The portion of unabsorbed loss, if any, shall be carried to subsequent years, where it will be set off only against what? Income from house property. Loss under the head, profits and gains of business on profession, including unabsorbed depreciation, any other head of income other than salaries. So, why salaries this was added? No, guys. Our CS only did this. Even, in the concept paper when you are checking out, I figured out why in other than salaries, our CA fellows, what they were doing. CA, let's say salary is some 40 lakh. Okay. So in that 40 lakh salary, what he'll do, he'll open one more small business and show credit of 40,000. This is some, certification work that he did. So a consulting work that he did. Basically for consulting, etc., you will not need any, COP. So then he showed expenses, car expense, that expense, this expense, like that, some 8 lakh expenses he showed. So basically, loss was how much? 7.6 lakh. This loss coolly started setting off with this. That's why they added this. Our fellows only do all this now, guys. Who else will do? Tell me. If you remember, also in 38.2, like if my salary again is 40 lakh and I have a car of 40 lakh, what I can do? I can show that same 40,000 income here. And expenses, I'll just show 1 lakh because this is not possible right now. And then I'll show depreciation of the car 6 lakh rupees. That's why in 38.2 we saw if you are using it for both business and non-business purposes, AO will now say, bro, that 6 lakh depreciation is only as against what? 40,000 rupees that you are earning. And out of 40 lakh, 40,000. Your overall income is 40 lakh and 40,000. So out of 40 lakh, 40,000 only I should take. 6 lakh is a portion like this that we had seen in 38.2 if you remember. So that also is there. One controlling point and this also. Both controlling points are there. Nothing you can do. Loss under the head, profit and gains of business or profession, including unabsorbed depreciation, can be set off only against any other income other than salaries. Long-term capital loss can be set off only against long-term capital gain as discussed. Loss from speculation business only against speculative business income. Specified business 35 AD only against specified business this thing, loss income. Loss from activity of owning and maintaining resources, same thing. Short-term capital loss suddenly set off against long-term capital gain or short-term capital gain. So STCG, LTCG. That's all, not any other income. Loss from any lottery, etc., that is not eligible at all. Then where law is silent on the order of set off, as I told you, may use one method, more than one method, the most beneficial method. We have seen examples here. These are all most beneficial method only. Law does not tell you how, what, etc. So I can use my most beneficial method. Law is silent. Carry forward and set off of losses. So carry forward and set off of losses. So basically, guys, even if I have my agricultural income and all, that cannot be set off. Carry forward and set off of losses. Where a loss computed could not be set off against the same or any other head of income, fully or partly, such unabsorbed loss shall be carried forward to subsequent year for set off. So if I could not do here inter head also, first intra head I'll try, not possible. Inter head I'll try, that also not possible. Means I will carry it forward and then set it off. So all this I've given here. Loss from house property can be carried forward for 8 years. To be carried forward and set off only against income from house property. Whether return of income to be filed within the due date, no important. Unabsorbed depreciation also no important. In all other cases, this we had done it also in PGBP if you remember. For what you are telling, God only knows. For that, please go back and check. We had done this. Loss from house property, 8 years, set off against income from house property. Unabsorbed depreciation, number of years, indefinite period. Any head of income other than salaries as discussed. Business loss, 8 years. To be carried forward and set off against profit and gains of business or profession. Alright guys, so guys please see here, loss under the head profit and gains can be set off against any other head of income. This is for that particular year. I'm not talking about carry forward. There are two things. Please understand. Do not get confused. One is what? Set off. Set off means what? Loss of that year set off against gain of that year. This is 70 and 71. Right? Whereas 70, if you see the carry forward and set off, that is 72. So don't get confused. So here I am telling you this is carry forward and set off. If I have carried forward the previous year's loss, etc., this year I can only set it off against what? Profits and gains of business or profession. Loss in speculation business, 4 years only. Income from speculation business only. Loss by specified business, income from any specified business only. Yes. For this, if you remember, it is indefinite period. We have already discussed in 35 AD. Loss under the head capital gains, 8 years, 8 years. Short term capital loss, short term or long term gains. Long term capital loss only against long term gains. Loss from the activity, same, 4 years. Income from specified business, 7 lakh, non-specified 10 lakh. So can I set off against this? No. Ulta, this I can. In this case, X cannot set off from unspecified business. We have seen this already. Why all that we have seen. Loss in speculation business. So guys, if you remember in PGBP, page B4, we had not done this part on purpose. And I told you there, we will see that later has come. So whatever I have left here, almost everything we would have covered. In fact, everything we have covered. So whatever we have left, wherever the different places, we would have covered in some other area. So once you sit for revision, everything will come to you easily. So where an SC carries on speculative transactions, is constitute a business. Such business shall be considered as a separate and distinct business. As discussed, it will not be taken as the same. It is separate and distinct business. Speculative business will be separate and distinct. So speculative transaction means a transaction in which contract for purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by actual delivery or of the commodity or scrips. So otherwise than by actual delivery, if you have done, let's say a normal contract where today I have asked that I will buy raw materials from you, let's say at 1 lakh rupees, or rather I will sell raw materials at 1 lakh raw materials at 1000 rupees. And I'll say, let's keep the deal for 2 days. You have to actually buy it. So I've already bought it. You will be paying in 2 days. In the next 2 days, the raw materials have, the material that I'm supposed to give you, the rate has come to 950 rupees. So now I'll say, boss, I'll do one thing. Anyway, I was supposed to sell you at 1000. Are you okay selling to me at 950? If you're okay with it, you're incurring a loss. But we already had a contract where I told you that I'll sell you the goods at 1000. And since now it has become 950, going forward further, the market will go down to 900, 800, whatever. And the contract now, whatever entered into, you will only suffer a loss. You will do one thing. I was supposed to supply that at 1000 today, but I want to buy it back. Though the goods are with me only, I want to buy back at 950. Are you okay with it? I will take the loss of 50, no problem. Are you okay with it? Or you should take the loss of 50 rupees. You will be protected from further loss. But this 50, are you ready to take? You will say yes. Then that is called a speculative business. Is a derivative transaction speculative business? No. People always misinterpret that derivative transactions are speculative business. Way back in 2005 only, amendment had come saying that speculative business is not, derivative business is not speculative business. Only the cash segment, intraday. That intraday only speculative, nothing else. Intraday is speculative. Nothing else. So if you deal in derivative instruments, forward contracts, etc., they are not speculative, right? So if you see, speculative and non-speculative transactions on a composite basis and maintain common accounts necessary to determine the income separately from speculative and non-speculative. So if you do derivative trading, normal forward contract, and you do intraday, then you need to figure out, you have to separate properly. Loss from a speculative business cannot be set off against income from regular business. Against such income or any other head, such loss can be set off only in 4 years. Where any part of the business consists of purchase and sale of shares of other companies. Reliance had manufacturing profits of 10,000 crore. Then they started buying and selling shares. And they said speculative business, this is also part of business. Then they made it business loss. Business loss was set off against business income. So 10,000 crore was, was used to set off these speculation losses that they were making. So to curb that practice from big companies from doing it, this provision was inserted. Where any part of the business of a company consists in the purchase and sale of shares of other company, shares, not derivatives, then such company shall be deemed to be carrying on speculative business, which means, again I am telling you, derivatives is not a speculative business. Derivatives is not a speculative business. Intraday, speculative. Simple words. Intraday is speculative. Derivative is not speculative. If you have one of the businesses manufacturing, etc., other part of the business is buying and selling of shares, that shares part is deemed to be speculation. To the extent to which the business consists of purchase and sale of shares. Transactions not deemed to be speculative. 1, 2 has become redundant because of 3. Any eligible transaction in respect of which trading in derivatives or commodity derivatives subject to commodities transaction tax on a recognized stock exchange. So earlier they used to do forward contracts, they used to do buying of raw materials, etc. Now everything will be treated as commodity derivatives. You can do it in MCX, and also you can do trade in derivatives forward contracts. So A and B was there earlier, C was introduced later, sometime in 2018. By insertion of 2018, this A and B have almost become redundant. So you can just remember 3 and go, it's fine. Any eligible transaction in respect of trading in derivatives or commodity derivatives subject to commodity transaction tax. If you see, commodity transaction tax was not applicable to agricultural products, agricultural commodities. So agricultural commodities, many judgments came that agricultural commodities are speculative business. These people went and told, sir, first of all, just because your commodity transaction tax is not applicable on agricultural products, you are making it speculation. So who will, first of all, agricultural products, no one will buy the commodities. If you put, this condition of speculation, nobody will even touch that. So please change it. So again in 2018, they amended it. CIT is not applicable on agricultural commodities. Trading in such commodities is not a speculative transaction. I am reading the PGBP notes, my dear friends, B4. That time if you had studied, nothing you would have understood. Now you are in a good position. What is eligible transaction? Eligible transaction in derivatives means any transaction carried out electronically on screen-based system. So till 2005, everything was deemed to be speculation, but then SEBI got a lot of control in 1992. 1992 2005 is almost 13, 14 years. So they said, no problem. Now everything is happening through a screen-based mechanism. So it's okay. Even if we, there is no chance for any false derivative transactions to happen because everything KYC, etc. is very strong, and SEBI registration is mandatory for everything. So we are sorted. That's what it says, SEBI and all these things, because it has to go through a stockbroker. When all transactions are disclosed with the transaction fee, it shall not be treated as speculative transaction. Same thing. When a party in breach accepts claims for damages, what actually happens is disposal of a dispute and not any settlement of any kind. So because it says here, no, here, settled otherwise than by actual delivery. I do not deliver the goods to you. So I'll say, bro, let's settle it. I'm sorry, there's a I had agreed to sell you at 100. Now the commodity is not with me. I'm sorry. You please buy it from outside. 110. 10 rupees I'll pay. Is it otherwise than an actual delivery? Went to court. They said, no, no, no. That is like a penalty in nature, damages. Amount paid as damages could not be disallowed as speculative loss. That is what we had seen there. So come back, guys. Hope you got that speculative business. Come to this now. Where part of the business consists of purchase or sale of shares of other companies, such company shall be deemed to be carrying on speculative transaction. We have seen this already. However, this will not, this is for Reliance type of companies, but this will not apply to where gross total income consists mainly of income on securities, income from house property, capital gains, income from other sources. So, if more than 50% of your income is from these areas, then you cannot say that this company is doing speculative transactions. Even if they are doing these transactions, you cannot say that the main business would be speculative transaction. Company whose principal business is trading in shares or granting loans. Main business only is that. 90% of their business is that. Then not possible. But in these cases, some other companies, what they were doing, equally they were doing, and actually more they were doing speculative and ensuring that other things were less. So that will not be allowed. Number of years for which any loss is allowed to be carried forward for set off starts from the immediately succeeding assessment year. So if there's a loss in assessment year 22-23, shall be carried forward 8 years, that is still assessment year 30-31. It shall start from the immediately succeeding assessment year in which the loss was first incurred or computed. So same 8 years. So from 23-24, 24-25, 25-26, 26-27, 27-28, 20-29, 29-30, 30-31. 1, 2, 3, 4, 5, 6, 7, 8, 30-31. Order for set off of losses, first current year depreciation, then brought forward losses from business or profession, and then unabsorbed depreciation. That's the best way to do so. And I am carrying forward the losses on 24. Suddenly I close my business. What to do? No problem. Continuance of business is not a precondition for carry forward of losses to the subsequent year. Even if business in respect of which loss is computed is discontinued also, no problem. The carry forward benefit shall not be denied. Loss from the activity of trading in derivatives is not to be treated as speculative loss, because the loss or gain from activity of trading also is not considered speculative income. That is why loss also is not considered as speculative loss. Loss from specified business, unabsorbed family planning expenditure, etc., and unabsorbed scientific are at par with unabsorbed depreciation. We had seen it during that time only. The requirements of section 80 to file the return is only applicable for carry forward of the loss. It does not impact the carry forward of loss of the previous years. It also we had seen. And this does not impact also depreciation. Depreciation, unabsorbed depreciation can be carried forward. Similarly, if you don't file the return of this year's loss cannot be carried forward. But last year's depreciation, this year's unabsorbed depreciation can be carried forward. Last year's loss for which you had filed the return can be carried forward. This year's only is not allowed. This also we had seen. That's fine. Amalgamation we had done. This also we had done. AA also we had done. in this PGBP, come to page B57, profits from discontinued business. So guys, basically you discontinue the business and you get remission, return from bad debts, etc. Under 41.1 you are charged, 41.3 you are charged, 41.4 you are charged. Any profit or gain after discontinuance of business shall be deemed to be the income under this section. We know that. Any loss incurred in the year in which the business was discontinued shall be allowed to be set off against such profit, and only the balance shall be taxed. This part also we hadn't done that time. Example. Business of the SSC discontinued on 28/2/1999. Business loss assessment year 99/2000 was 5 lakh. Brought forward business loss 96/97 to 98/99, 8 lakh. Today I recover the bad debt on 31/3/21, 7 lakh. What is the tax treatment? So if you see for assessment year 21/22, PGBP under 41.4, it's the recovery of bad debt, 7 lakhs. Can I set off this 8 lakh or can I set off only 5 lakh is the question. Read that carefully. Page B57. Any loss incurred in the year in which business was discontinued. In this example, 99/2000, 5 lakh only shall be allowed to be set off against the profit. Only 5 lakh is allowed, my dear friends. So 2 lakh will be the scene. Suppose, instead of this 7 lakh, you got 4 lakh in 1 year, 3 lakh in the other year. Then in that year when you which got 4 lakh can be set off. And the year in which get 3 lakh, next year if you get 3 lakh, 4 already set off, no? 1 can be set off here. So that is what you need to keep that in mind. These are all exceptions where losses can be carried forward to 8 years. No, this is an exception. This can be carried out multiple, number of years, all those things. One more. We had done section 33B, which is no longer there, if you remember. Rehabilitation allowance. It was only there till 1984 and 85. Leave guys, not relevant, leave it. Simply, can do everything, but then it will simply create confusion. So leave that, no problem. There was one more case law. BCS Kartar Chit Fund. When the losses sustained are not set off against the profits in 1 year, you cannot choose to set off in the another year. Example, with an example, we'll find out, don't worry. Assessment year 1920. Carried forward loss, PGBP, 1,60,000. Assessment year 2021. income is 2,50,000. Assessment year 21-22. It is 13 lakh. Since you are an individual, assume it's 2,50,000 anyway. It's below the exemption limit, so you will not set off. You will ignore. Next year, can you set off? There is no rule, nothing in the entire Income Tax Act. So here they said nothing doing. Loss of 1,60,000. If you miss out in 1 year here, cannot be done at the profits of the next year. This was one case law. BCS Kartar Chit Fund. Since a little bit extra, I thought I'll do it. Commodities and all we saw, nothing to worry. Intraday, interday. And anything if it is derivatives marked to market, because of accounting standards, if you have to mark to market and if you have to show the loss, that loss and all cannot be called as speculative loss under income tax. Only at the time of selling, you should take into account. These things are some basic points. So activity of maintaining race horses also, basically if I, what do you say, maintain the race horses in every race, I will get a percentage. I'm not betting on it, but if my horse wins, I will get 10%, 20% like that. So that should be set off only against the, losses in that particular business cannot be done in other cases that we have seen already. So if you are selling shares only, guys, one important thing that I told you here, only if you are selling shares, come here. Shares, not derivatives, not units. So because there was an Apollo Tires case law. In Apollo Tires has got nothing to it, it's a tire company. They were purchasing some units of UTI which went to a loss. They decided that's PGBP because they are trading and they set it off against the Apollo Tire ka income. Assessing officer said, no, this is speculative business. It went to court. They said, no, it's clearly written shares, not units, not derivatives, nothing. All this we did here. Yeah, accumulated loss and unobserved depreciation of predecessor firm or a proprietary concern. So sole proprietor or a firm converting to a company, that happens. Deemed to be the loss and unobserved depreciation of the successor company. It will go there. Set off will be for a fresh period of 8 assessment years. So this also we had seen that it should go there properly. Similarly, private limited company, unlisted company into LLP also same, fresh period of 8 assessment years. This is interesting, guys. Carry forward and set off of losses in case of closely held companies. So guys, public company merging, amalgamation, demerger, etc. is there. So they do it only so that they can take the benefit of carry forward. Private companies, we have other conversion of into LLP and all is there. But now, closely held company. So one closely held company basically means it's almost like a private company. Either it's a private company or it's a public company with only few number of members. So what happens is, a company which was doing pretty well goes into losses, and it's already further into losses now. Shareholders A and B are there. Those shareholders, the shares are sold to a better company which is doing well. So by this, what happens? All the assets go there, and basically the shares, 100% shares are sold to that other person. So then he will use, these assets, etc. Will, all the losses here he will take over and he will set off. That used to happen. Whereby a closely held company which was going into losses was taken over by another person by taking over the full 100% shares of this company, and thereby using the benefit of carry forward set off. This had to be nipped properly in the bud. So section 79 was inserted saying that, boss, if you do this golmaal activities for tax planning, more than tax planning is more of tax evasion, I will not allow. Or, instead, no problem, you sell it off. I am not saying no to it, but carry forward benefit I will not give. If you want carry forward benefit, let us say a better management wants to come and take over your company. But that be the case, you still want to be the shareholder, but you still want to take all the benefits. Then I will give you one condition. And that condition is, if you are holding minimum 51% voting power, that same you should also hold. This is at the time of incurring of losses. Same you should hold even later, whenever you are availing the benefit of set off or carry forward. Startups came. Startups are predominantly private companies, closely held companies. They said, sir, we have 100% share today, but tomorrow we will sell 20%, then we will sell 20%. So eventually, though we have 100%, lot of losses, sir, in the startup field, 5 years full loss. 6th year, a venture capitalist will come, and then he will, less than like 3 years, 4 years, venture capitalist will come. We are going for funding. He will give super funding, and he will take a stake. 4-5 capitalists will come and take a stake of 51%. They'll take over the company. Then will you get benefit of set off carry forward? No. So startups did not get this benefit. So the other VCs, in that VC, V is useless only. It's capitalists. There is a show called TVF Pictures. Watch it. In that only I learned this dialogue. Good show. First came out in 2015. Now it came in, I think, 2023. One more. So you check it out. So what I'm saying is, this taking over, no. Startups also will taken over by other companies for this benefit of set off. Now this is not allowed because the founders only don't have 51% stake. So they went and told the government, do something about us. So for non-startups, that condition is there. If you held 51% before, now also you should hold 51%. But for startups, 2 they gave, guys. One was this 51% rule. If you cannot follow that, one more rule. One more rule was what? The shareholders of the company, when at the time of incurring of the loss, should remain the shareholders of this company. They did not specify the percentage. They said the shareholders who are holding some shares, let's say 10 lakh shares, should continue to hold the same shares. Because you would have given more, issued more shares, right? You have issued 1 crore shares now, or you have issued 80 lakh shares now. Earlier 10 lakh out of 10 lakh you held. Now you are holding 10 lakh out of 90 lakh. So they said the shareholding should continue. Then the issue comes, what if there is a death and you are getting the shares in succession? Legal hair. What if there's a gift? What if under insolvency and bankruptcy code the shares are taken over by somebody else? What happens then? So for that there are some exceptions. So guys, very simple. For non-startup this is the scene. For startup this is the scene. Check it out. The unabsorbed business loss of a company, depreciation 79 will not apply. Important. Kalpaka in Enterprises. Supreme Court decision. 79, no restriction for unabsorbed depreciation, only business loss. In which public are not substantially interested, closely held company can be carried forward and set off against the income in a subsequent assessment year, provided that on the last day of the previous year, the shares of the company carrying not less than 51% of the voting power are held by the persons who beneficially held the shares, carrying not less than 51% of the voting power on the last day of the previous year in which the loss was incurred. See, shares of the company carrying not less than 51% voting power are held by the persons who beneficially held the shares, carrying not less than 51% on the last day of the previous year in which the loss was incurred. The same fellow should be there. Same fellow should be there. Right? So, for example, previous year 31/3/2019, current year PGBP, I mean that year PGBP. So 2 lakh was loss. 31/3/2020, 3 lakh was loss. 31/3/2021, 10 lakh profit. This 2019, it would be carried forward here if 51% same people are there, shareholding, I mean voting power. Similarly, this will also be carried forward here. The same thing happens. Whoever were there here, 51% should come here. Similarly, this 3 lakh will go here if 51% is there. Otherwise, not possible. Otherwise, not possible. So, for instance, 31/3/2019, 31/3/2020, 31/3/21. A, B, C, D shareholders, 30%, 25%, 20%, 25%. Here, 30%, 25%, 20%, 25%, 30%, 25%, 20%, 25%. Here A, B, E, F. Here X, B, E, F. 2 lakh loss, 0, 7 lakh profit. So you see, this 2 lakh will go here if people holding 50% is there. A, B is there. 55%, no problem. Will this again be carried forward to next year? I need to see. Here you see AB. Only B is there. (31/3/2019) will be carried forward here, but this will not be carried forward here because even though 31/3/2020 as on this year end, these three are the same. I should not see this. See the rule in which the loss was incurred. In this, when was the loss incurred, my dear friends? 2019. In that, who is the only common fellow? B. What is the shareholding? 25%. So, are they held by the same guy or guys holding 51%? No. So, this 2 lakh will not be carried forward here in a closely held company. But if A had gifted his shares to X, his relative, then I told you gift will not be considered as change in shareholding. So, it's as if A is holding. So, AB, AB, AB. Instead of AB, XB, then it will be a yes. So I hope you got the point. Startup. In case of eligible startup, operates an exception to 79A. To promote Startup India, permits deviation in shareholding, provided it's an eligible startup. All the shareholders of the company who held the shares carrying voting power on the last day continue to hold the shares. Shareholders should be the same. Means when company was started by AB, here you can have A, B, C, D, E, F, X, I don't care. And the shareholding of 51% can be 20% also, I don't care. But the shareholders must be same. Basically, promoter should not exit. That is the crux of the startup. No promoter exit is allowed. If you promoter exits, you will not get the carry forward benefit. And such loss has been incurred during the period of 7 years beginning from the year of incorporation. Only 7 years loss is allowed. As I told you, exception is 79A and B. When share change in the voting power and shareholding takes place in the previous year due to death of the shareholder, gift of shares by a shareholder to his relative, there is a change in the shareholding of an Indian company, a subsidiary of a foreign company as a result of amalgamation or demerger of a foreign company. Change in the shareholding of an Indian company which is a subsidiary of a foreign company. Practical example. Brook Bond foreign company has a subsidiary Falcon Private Limited and Lipton Incorporated foreign company. So this will get demerged and it will come here. So now what is the rule here? Where a change in the shareholding of an Indian company, Falcon Private Limited, it's a subsidiary of a foreign company, Brook Bond, as a result of amalgamation or demerger. However, 51% of the share of the amalgamating or demerged foreign company is Brook Bond, shall continue to be the shareholders of the amalgamated or resulting foreign company. That is your Lipton Falcon. That actually practically happened. So 51% if they remain the same, then this benefit is allowed because it's a private company, remember, Falcon Private Limited. If it was a public company, already covered in 72A and all those things. Either way, the change in shareholding happens through resolution plan through IBC. When IBC guys, a new management will come and take over the old management. That be the case, obviously shareholders will change, everything will change. So that's okay. Then 47, 7AC, 7AD we have already seen. In those cases, if it happens, absolutely no problem. Where your NCLT has suspended the board of directors, all those things. Here. 47, 7AD, 7AC already seen. Will not apply to company, subsidiary, etc. if NCLT has suspended the directors under 241. 241 is operation and mismanagement. Under operation and mismanagement, I have thrown out the old directors, brought in new directors. In that be the case, appointed new directors, then no problem. Similarly, change as shareholding also has taken place through 242. Thereby, they will in NCLT can, these directors only will hold the shares in closely held company, no? So I will take away from them and give it to somebody else. So all that is fine. Unabsorbed depreciation already discussed. An LLP is also eligible for reduction at ATIAC. Change in constitution of LLP in view of a fresh induction of partner does not affect the position of carry forward. Just because a new fellow comes, reconstitution, but doesn't mean that carry forward benefit you will not get. A company which is an eligible startup but ceases to be a startup, position of carry forward shall be as follows. Where there is a change in shareholding, 72A. There is no change in shareholding, normal 72 will apply if it is no longer a startup. Because for only for startup, 72B will come. Carry forward and set off of loss for discontinued business, already told you this is what we had discussed. Up to 8 assessment years in which the business is discontinued. Beyond 8 assessment years shall be set off only against the income of discontinued business for an indefinite period. This is what we saw, 41.5. No set off of losses consequent to search, requisition and survey. We had seen this in assessment procedure. where consequent to search under 132 requisition 130 this thing, total income of the previous year includes any undisclosed income, then of course it has been recorded, disclosed. We had seen this already in assessment procedure 79 capital A. Please recall. That's all guys. Chiller chapter. Very easy chapter this is. Set off and carry forward. Some small things are there. We'll finish it off. That's it. One more session. We will wind up with the chapters. Very easy. We will do some small areas. We'll finish it off. Okay. And then that's it. Nothing more. As I told you, all the major stuff is already done, guys, before international taxation and international taxation came. These are all small areas. We'll finish it off. Okay. See you.